You've heard of buy the dip before, Mikey. Buy the dip is an idea that actually might be older than you and me. And it usually lends itself to the equity market. Today, we're going to talk about this idea in cryptocurrency. But before we do talk about it in cryptocurrency, why don't you give everybody a little, context as to what buy the dip means when you see it on social media and otherwise?
I did not know its history was before our inception, but maybe
just like the idea of buying something that has fallen in price has probably existed since the invention of markets that you could buy.
And our generation just added one more word to it, like buy the effing dip is like what you'll normally see on Reddit forums or Twitter or whatever. And it speaks to the idea of like, we've only seen the stock market basically rally since 2009. So any opportunity to get in at cheaper, I'm going to invest. And fortunately for many people, that strategy has held true. I don't think it always will. We've seen some pretty severe market corrections since we've walked this planet, Frank. And then kind of from the stock world, it made its way over to the crypto world of like holding to the moon is a similar phrase. But yeah, basically things are cheaper than they were previously. So buy more and they will only go up tends to be the mentality. Not one I follow, but certainly out there.
And while I appreciate all of Mikey's insights as to what goes on Reddit and elsewhere, inserting the effing in there, I don't see that on my thread, man. I don't know who you're following.
Similar to like TLDR, it's BTFD.
They're not G-rated there, but it is this idea that I do want to put some stats behind, because as people who watch us know and follow me specifically know that like I don't like to make decisions that aren't based in data, statistics. My gut, while it might be good for many things, is not something I like to follow in terms of like, I got a hunch that this thing's going to go higher. So let's look into it. But let's start with just the general idea of like stocks and Bitcoin are very different. You look at these charts, and while both markets are higher, they move totally differently. And you look at the correlations here, and it's really a mixed bag at best. Of course, there are times where stocks and Bitcoin have been starkly negatively correlated. They've been as high as 0.5 correlation. Right now, less than 0.25, as close to zero as really you get. And this just presents, why do I present this when we're talking about buying the dip in stocks and Bitcoin? Well, it's simply to show you that these markets on the face of them are not very similar. Like that, they present diversified opportunity in that if I'm long stocks and long Bitcoin, I'm not hedged, but I'm also not necessarily increased in risk. If I'm long stock, short Bitcoin, if I'm short stock, short Bitcoin, vice, all the different combinations, one doesn't depend on the other, and one doesn't dictate movement in the other. Is that all making sense here? You know this better than anyone because you trade many different cryptocurrencies and stock markets.
Absolutely, and there's this conventional idea, and I think it holds in crypto too. I'll get to it in a second. But with stocks, it's like energy stocks are different from material stocks, which are different from healthcare stocks, and they all are diversified. If you're invested in many different ones, your portfolio would be okay. But the shocker is that when stocks sell off, they tend to all sell off together. So your exposure in healthcare and materials and biotech, whatever, it's all going to move. The concept is correlations converge to one when things sell off. And that holds true in the stock world, as it does kind of hold true in crypto as well, where like Bitcoin and Ethereum move together and they move similar to Litecoin and all these other altcoins that are coming up. But on a whole, those two asset classes move completely distinct from each other.
Yep.
And I even looked at Bitcoin versus other markets like interest rates and foreign exchange markets and energy markets, and crypto moves completely different from them as well. So when you talk about diversification, it's in the asset classes and not the subsectors of them.
And those are great examples to bring up for for today's conversation, because when we're talking about buying the dip, what has to happen? Well, the market needs to dip. And when we talk about a dip, we don't talk about 0.2% lower, 0.3% lower. We're talking multi-percentage points lower. When they're the best opportunity to buy most times is when markets are screaming lower and everyone's trying to get out. And it's like, oh my gosh, something crazy's going on. And then in the next 24 hours, they're like, oh, it's actually not as crazy as we thought. And that's where the bounce comes. That's where the buying the dip opportunity comes from here. And you make a great point, which is like, when the stock market is dipping, it's not like, oh, well, I'll just buy energy stocks and technology stocks and industrial stocks and I'm diversified. No, if the market dips and then they dip again the next day, they're all going lower. Like it might be, a matter of degrees, but they're all going lower. Correlations do go to 1 in the stock world, same as you kind of posed in the crypto world, which I'm not surprised by, but having the opportunities in stocks and crypto and knowing that they're distinct, that those correlations don't necessarily go to 1, though we saw a little flash of it earlier this week, which is not to say that it can't happen, but we've seen multiple occurrences of stocks moving higher, crypto crashing. And that's really nice to see when you're talking about a strategy like buying the dip and being comfortable with the idea of doing that in these two separate markets, knowing that they're diversified, unlike, ExxonMobil and Apple, if the market's crashing, I'm diversified. It's like, no, if the market keeps crashing, one of those stocks isn't just going to surprisingly do better. The stock markets do tend to move lower. Now, Mikey, this is a very busy slide. It's got a lot of information in it here. And it poses one of the things that Bitcoin and stocks have in common, which is the potential to buy the dip. And I think you would have probably from anecdotal evidence thought that this was the case. But I wanted to put some data in here from the start of the year to now, looking at the, any day statistics, any given day, every single day of 2021 thus far, Bitcoin has tended to move higher on that given day 51% of the time, and the average move is about $50. That's really close to just like nothing, right? Like it doesn't tend to move higher or lower. 51% is as close to 50-50 as you can get. Now, after a down day, and I didn't even measure for like a big down day, just down days in general, those odds of Bitcoin moving higher go from 51% to 56%. And that average move goes from up $50 to up $300. That might not seem like a lot to the new, day trader, the new active participant in financial markets, but that's a big fat edge, Mikey, right?
Yeah, and the reason it's so important is because it's a numbers game. Yeah. Like if you buy this edge and you win 56% of the time, and you do this 1,000 times, that really adds up. So it may not look like that much. I mean, ideally it's like 70-30 or something like that. But
99-1 would be great. Yeah.
But actually like 56-44 is a really nice edge, especially given the magnitude of the move. And I like that you were able to find a way to model this buying the dip behavior. It's pretty cool to see. I'm not sure I would have expected it to be this cut and dry. And I like that you've laid it out this way, because there are definitely people, we saw it 2 weeks ago when crypto really sold off on Monday. It didn't close on those lows. People stepped in and tried to buy it back a little bit. This isn't even including that data as well. So,
well, and I pose here the chart in the background, which is Tuesday of this week, where you have both markets, both stocks and crypto moving lower together, which doesn't happen all the time given that correlation we just talked about. And yeah, they bounced back intraday, and overnight they bounced back and then kind of came actually a little bit lower today. And this is all what we've been talking about, which is like crypto, it's its own distinct thing, and it's its own asset class that isn't, digital gold. It isn't, technology stocks and everything else. But for the active trader, it presents a lot of similar opportunities in here, buying the dip being one of them. And what I love about this slide is that I put it together and thus it's great. No, but the first statistic is kind of telling you that 49% of the time, so if there's 250 trading days, essentially 120 to 125 of those trading days, the market is going to dip. And so that second statistic now depends on half of the time. So when you say like, oh, if you do this thing a couple hundred times or you do it 1,000 times and you reach, by the law of large numbers, that 56% success rate and that average profit of $300, a lot of people would be like, oh, yeah, but I have to, how am I going to find 100 occurrences or 200 occurrences? There's 120 every single year in this market. And so that's really nice to know. And to bring it on home, I would be remiss if I didn't bring up the fact that small crypto will carry these similar attributes to Bitcoin. It's very highly correlated with Bitcoin and Ethereum, and thus should have this buying the dip opportunity. But what will be really nice is it's a smaller product. Instead of moving thousands of dollars per day in Bitcoin and hundreds in Ethereum, and not having the flexibility to buy and sell it quickly, this is a futures product in SCCX that'll let you buy the dip and sell it back intraday and do so with very, very low fees. And so we're really excited about strategies like buying the dip or just pure price action strategies and how they lend to this new product.
Yeah, it's a great point. It's a really interesting product for day traders and investors alike. And I'm super excited for next Monday to get this thing out there, because I keep hammering this home. Yes, it's a crypto equity index future, but it holds Grayscale Bitcoin and Grayscale Ethereum. So you're actually getting spot crypto exposure. So
yeah,
everything we talked about, like sector correlations, you don't really have to worry about that with SCCX, because it actually has some spot exposure. So it's going to be really cool to trade, open up a whole ton of pairs, and just like short-term opportunity that you can't get in the spot world.
Absolutely, man. I'm always excited. Like I say, like we said at the start, opinions of crypto aside, it's a market with a lot of price action that's unlike anything else. And thus, I'm excited to trade it, man. And it's going to be really nice to have an easily accessible, for lack of a better term, cheap product to get in and out of our crypto trades. But Mikey, that is enough of you here for today. Thanks as always for joining us here on Small Stakes. We have an absolute ball. You'll be seeing more of Mikey on Friday, but hang around. Splash into Futures is coming up next. Peter Molmat and I are going to have a bunch of trades. Thanks for watching, everybody.